Good morning, everyone. I hope everybody's doing well. Uh, this morning, I just want to give you guys some short definitions of option trading. But before I do that, I just want you guys to know today I have no anything to update you concerning my option trading because today, Monday, the 18th, it's a holiday here today, so the stock markets will start tomorrow, Tuesday, the 19th to Friday. So I haven't done any trading today. So I just want to explain some terms in stocks. First of all, I just want to explain what stock is. Option stock. People at times want to know what is option, what is option, what is option in stock trading. So options in stock trading is simply like it's a contract that gives the buyer the right but not the obligation to buy or sell and to buy or sell an underlying asset at a specific price or before a certain date, or it gives the trader or the investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. Some simply options is a contract, that is always entered between two people. Or yes, so I have a contract, I have a share, I'm selling it like I'm buying a shares from Apple. Okay, Apple have current price now is 150. So and as a 150, he's saying okay, there is some price you have to agree upon to buy. That is what we call the strike price, and the strike price is normally set above the current price. Let's assume the Apple is trading or selling its shares now at $150. I will look at the strike price, which is 150. It could be 150, 152, or 150.50 cent, or 151, or 152. So I will look at it and say, okay, I'm taking 151. As the 151 I'm taking, when will I want it to expire? Did I want it to expire in 1 week time, 2 weeks time, 3 weeks time, or a month time, or 2 months time? So I'll also select what? The expiration date. So basically, that is the contract. I'm buying it. Apple today at it's Apple's current price now today is 150, and I'm taking 151 as my strike price, and I'm paying this amount. It could be 200, 250, and I want it to expire in what? In 2 weeks time or 1 week time. So I'll select that. So and if I'm selecting a 1 week time, if it expired with expired that the price went up, I make profit. When it comes down, I make a loss. So that is simply what the contract means. And also bear in mind that when you are buying options, there is always you have to always bear in mind that if you're buying 100 shares, it represents one contract. So simply, if you're buying one contract, it represents what? 100 shares. So let's assume that I'm buying Apple today. The current price is 150. I'm buying it options. current price is 150. I'm selecting the strike price to be 151, and I'm paying $220 for that. Expiration will be in 1 week time. I'm selecting. I'm buying. That means that I'm buying 100 shares. That's one contract. I'm buying one contract with what, 100 shares. So the moment it started going up and I'm making some profit, uh, at the end, when you make the profit, wherever you multiply by the 100 shares you buy. So basically, that is what options trading means. We have two types of options. We have the call option and the put option. The call option is a financial contract that gives the option buyer the right but not the obligation to buy a stock, bond, commodity, or other asset or instrument at a specified price within a specific time period. Or a call option profit the buyer when the underlying assets increase in price. Or call can be a bet that a stock will rise. Simply means you buy it with the intention that the stock will go up higher. That is what we call what? Call options. And we have the put options. The put option is the contract allowing it holder the right to sell a set number of equity shares at a strike prior to expiration, or a contract that gives the owner the right but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. Or a put options simply means that you bet that the stock will fall down. The stock will come down. That is just the simplest way to explain it. You buy the stock with the intention that the stock will come down. We have another term we call the strike price. The strike price. The strike price is a set price at which a derivative contract can be bought or sold when it is exercised. For the call option, the strike price is the price at which an underlying stock can be bought. It is normally set above or within the current price. Yes, simply means, okay, I'm buying a call option. My strike price will be what? So let's give you an example. I'm buying Apple today, and the Apple price now is $150. So I'll look at the strike prices. The strike prices at times, if it's 150, it can be the strike price could be 150.50 cent, 151, 152, 153. So I will now look at that and say, okay, I'm taking 151 as my strike price. And as I take 151, how much will I pay for that? It could be $200, $150, $250. And when is it going to expire? In a week time, 2 weeks time? So I'll now look at the strike price. So the strike price is simply set above the current price or within. So I just said it. I'm buying Apple, and the Apple price is $150 now. So, and I look at the current the strike prices are set there is 151, 152, 153. So I decided to take 151 as my strike price. So the moment the price went up to 151 and going up, I'm started making profit. So that is my strike price. It's always set above the current price. All right, so that is it. So that is why that I'm saying, if I'm buying call option, that's what I'll do. And when I'm buying put option, I'll make sure that And if I'm buying the put option, I'll also look the put options. The current price of Apple now is 150, and I look at the put options. It could be 149, 148. The set is sets down, so means you want the put option means you want the price to come down. So the strike price could be 150. If the current price for Apple is 150 now, the strike price could be 140, 149, 148, and downwards. So I will select 148 to mean that 149 to mean that if the price of Apple dropped from 150 to 149 coming down, I'll start to make what? Profit. So I'll pick 149 as my strike price. So simply that is what the strike price means. At times too, you see some terms they call in the money option. In the money option means you are looking at. I'm going to look at it in terms of option call options. A call option is in the money if the market price is above the strike price. So that is it. So assuming I'm buying Apple today, which is 150, and the strike price is 151. So the moment is moved from 151.50 to 152, 153, means I'm in the money. So I'm starting to make money. So that term is what called in the money. And the call up and the put option is if the Apple price is 150 and the strike price is 149, when it falls within 149 coming down, I'm also what? In the money. I'm also what? In the money. So we have another term called out of the money. Out of the money means for the call option is out of the money if the underlying price is below the strike price. Yes, let's assume I'm buying an option call, and my strike price for Apple, my strike price is 150, and my current price is 150, and my strike price is 151. The moment it started dropping down from 150 coming down, but not going to 151, but it's coming 150 coming down. It means I'm out of the money. It means I'm not making profit. That is what, in terms of the call options. But in the put option is out of the money if the underlying price above the strike price. Let's assume that I bought a Apple for 150 as my current price, and my put option and my strike price is 149. When it's not 149 coming down, but it's 149 is going to 150, 151, 152, means it's going up, means I'm making what? A loss, means I'm out of the money. And that is what? The put option. It means I'm out of the money. So another term is, should I buy in the money or out of the money? It's better you buy out of the money, because out of the money means the stock is coming down. So if it's coming down, the price of the stock comes down. So you buy that during that time, but not in the money. So that is what I say. Out of the money options are cheaper than other options since they need the stock to move significantly to become profitable. The further out of the money an option is, the cheaper it is, because it becomes less likely that underlining will reach the distant strike price. Yeah, so that is the period you like to buy. And we have another term we call the sell to close. Sell to close means you want to sell the what? The option. That's another term for what? Selling your option shares, or selling your options. And buy to close means you're trying to buy what? Your options. or your shares, or let's say Apple. If I want to buy, means it means I'm buying to close, and I want to sell means I'm sell to close. That's another term so you can use. And there's another term we call the bullish strategies. Bullish strategies is a strategy. It's a trading strategy used when options traders expect the underlying assets to rise. Yeah, this is a period where you expect the assets to go up, to rise. That's the bullish strategies. And the bearish strategy are employed when the option trader expects the underlying stock price to move downwards. It is necessary to assess how low the stock price can go and the time frame in which the decline will happen in order to select optimum trading strategy. Yeah, the bearish strategies is during the time that the stock begins to fall down, go down. That's the bearish strategy. So at this time, I would like to end here. I'll give you some guys another terms in trading, probably tomorrow. And so I will encourage you guys to try and subscribe to my channel, share, and I will see you guys tomorrow with another update. Thank you. Have a nice day. Also, don't forget to leave a comment. All right. Thank you. Bye-bye.